This is a previous podcast replay. Law Firm Finances Basics, episode 265. Are you ready to make your law firm a profit-generating machine that will free up your time and skyrocket your impact? With more than 2 decades of business growth experience and having proven that you can be successful while prioritizing your family and your impact, introducing the Profit with Law podcast. I am your host, the creator of the Firm Differentiator 10X Effect, Moshe Amsel. Well, hello and welcome to another episode of the Profit with Law podcast. I'm your host, Moshe Amsel, and today I want to continue the financial conversation. So we had a couple of episodes talking about Profit First. We had a guest who had implemented Profit First, but Profit First is a cash flow, cash management strategy. It's not the only way. And I think that there's more important basic information that you need to understand about how your business operates, that if we don't cover the basics, talking about these other topics is kind of moot. It's kind of not doing you justice, and I'm not being of service to you. So what I'm going to do today is I'm actually going to pull training that I did for our incubator. So the Law Firm Growth Incubator is designed and intended for small firms who are bringing in basically less than $250K of revenue. You definitely can stay in there or be a member in there greater than that. But we cover a lot of the topics that small growing law firms struggle with, which is, how do I get clients? How do I figure out which technology to implement, and how do I get my technology all to work and talk to each other? And then how do I know how to manage my money, how to bring on staff, when is the right time to bring on staff, and all those kinds of decisions. So the incubator is essentially a monthly membership where I have partnered with Mark Homer from GNGF, amazing marketing company that focuses only on law firms, and Melanie Leonard from Streamlined Legal, which is a company that does technology implementation for law firms. Basically, they help you with customizing your specific software to do what you need it to do for your firm. And Mark, Melanie, and myself have joined forces to create this product where every single week we have a call where we discuss one of those topics. Occasionally we bring in a guest, and we also have Q&A session for our members. So if you want to learn more about joining the Law Firm Growth Incubator, you want to go to profitwithlaw.com/incubator, profitwithlaw.com/incubator. Join us. It's only $97 a month, and you get access to amazing people who can really help you move your law firm forward. So I'm just going to queue up the replay of the training that I did. Did this training back in June. And it's a Law Firm Finances Basics, and really goes into understanding why you need to keep accurate track of your financials, why you need to maintain your books, and how to read the reports that those put out. We have a conversation about taking on debt, understanding when is the right time to take on debt. Is debt good or bad? And we also cover taxes, and that might be most relevant for people in the United States. So for my international listeners, that one section might not be particularly relevant to you, but you can translate the information there into the taxes in your specific country. And finally, implementing financial processes and why they're so important. So a lot of really key areas in the basics of understanding your finances to be covered in this episode. And just to really help my podcast listeners, I wanted you to be able to see the screen that I was sharing. I wanted you to be able to see the slide deck that I was using. So what we're going to do is we're going to embed the video recording of this, which is normally those trainings are only available to incubator members, but I want to be of service to you in the best way possible. So we're going to embed that video in the show notes page for this episode. So this is episode 119. So you're going to go to profitwithlaw.com/119, and there you'll see the video. You'll be able to play it and watch the training there if you want to do the video. You could definitely listen here on the podcast. You'll get a lot of value, but I encourage you, for anything that you're just confused about what you're hearing on audio, go back and watch the video portion of that specific section of the training. So here you go. I'm going to queue up that recording now. The first thing we're going to talk about is tracking your financials, and then we're going to go into understanding your financials. I'm sorry about that word going to the next line. That should have been fixed. And from there, we're going to go into what is cash flow. Then we're going to cover debt, good or bad. Following that, we're going to cover taxes, the law firm owner's secret nemesis. And finally, financial processes and why they are so important. So that's basically the overview of what we're going to cover. And we're going to start with tracking your financials. So when it comes to tracking your financials, the first thing that I want to get my point across is that you need to use accounting software. And I'm not saying that because I'm an accountant and we sell bookkeeping services, and therefore I want you to use the software. We want you to use our bookkeeping services because bookkeeping is going to be what we talk about next. But I'm going to make a case for you of why it's important to use accounting software. So tracking your financials requires that you have accounting software. It requires that you do your bookkeeping. And my recommendation is that you use a bookkeeper. And I'm going to go into each of these in a little bit more detail in just a moment. And then to create a cadence or a schedule for paying bills and updating the books. So you want to make sure that you're not constantly needing to go in there. You don't want to be monitoring it like a hawk every day. That's not healthy. It's not good. And you want to also make sure that that's a schedule that works for getting your bills paid. So using accounting software, here are some reasons why you need to use accounting software. First of all, it allows you to track your financials accurately. Now, it's very possible at the beginning when you first get started that you can literally do this on a spreadsheet. The problem is that it very quickly becomes something that is not very realistic. As soon as you have more than one bank account, you add a credit card, you are not putting every transaction into the spreadsheet. You have more clients coming in, your volume is picking up. It becomes unwieldy and really not something that is very useful to use. Tracking your financials accurately is really critical to you as a business owner. So you as a business owner want to be able to make decisions from a place of knowledge. You want to be able to have the data driving the decisions, and therefore you want to come at it from a point of knowing what your financials are. So we want to track our financials accurately. Then we want to be able to do reporting based on those financials. We're going to get into reporting in detail today. We're going to talk about the profit and loss statement, a balance sheet, and understanding what those things mean and how to use them. We want to make sure that we're able to do reporting, and that's going to be done within the accounting software. You can still do that with a spreadsheet, but it requires a lot of manual intervention to create those reports. Again, I strongly recommend against it, even when you're first starting out. I mean, there's cheap enough options out there that this is something that you don't really want to skimp on. You also have in your accounting software, you have your bank feed connectivity as a possibility, depending on the software you're using. And the beauty of bank feed connectivity is that you don't need to be entering every transaction. It automatically comes into the software, and you simply need to categorize that item to get it cleared and into the books. And that allows for this to be a much easier process, especially if you're doing it yourself, which I recommend against. But it allows it to be a much easier process. And it even allows that if you're hiring a bookkeeper, for it to be easier for them, so they don't have to charge you as much for their work because they're not spending time entering every transaction in. At the end of every month, you need to reconcile your bank statement against the books. So you need to make sure that there weren't any entries that were missed. You want to make sure that you know which transactions are still outstanding. So that bank reconciliation that happens at the end of the month has to be done. And software allows you to do that very easily, where you basically put in your ending balance and you check off all the transactions that are already in the books that match the statement, and hopefully everything works out and it zeroes out and you're done. And that process is something you have to do. You want to make sure there aren't errors in your books, and the software makes that really easy. So those are reasons for using accounting software. I'm sorry, there's one more: outstanding checks. So when you write a check, it goes in the mail, it goes to somebody, they deposit it. There's a lag from when you write the check until it gets deposited. And you probably know from your own personal experience that it can be a long lag. It can really go. Sometimes somebody can forget to deposit it, it got lost in the mail. It could be out there for a month, 2 months. You're easily going to forget which checks cleared or which ones didn't. And then you might not have enough cash in the account to cover those checks that were written. So you want to know what those outstanding checks are. And I'm looking in the comments and I see that somebody's talking about duplicate entry. So we can definitely talk about how accounting software interacts with the practice management software as far as the billing versus managing the finances of the business. So I'll actually segue into that in a moment. I didn't make a slide for it, but we'll talk about it. So you want to consider cloud-based software. I recommend QBO and Xero. Those are the two front runners. And the reason that you want to use cloud-based software is simply that you can share it with your accountant. Your accountant can get access to it easily. Your accountant is probably using that software already because most people are on these two platforms. And they are, because they're very mature products, they're very robust in their feature set and capabilities. Now, some of those you're not going to use. You're not going to ever need to do inventory management as a law firm. But you are going to need to pay bills. You're going to need to manage your cash flow. You're going to need to do all the things that a business needs to do. And the other thing is these cloud-based applications have open APIs just like anything else where other software can connect to it. One example is connecting your practice management software to the platform. So for example, if you're using Clio can connect to QBO, to QuickBooks, and to Xero. And in Clio, you're doing the billing side of the business. Now, the reason you still need accounting software is because Clio is not intended to be accounting software. They're not trying to be accounting software. They only do the tracking of your hours and the retainer replenishment and the billing side of it. So that the inbound cash flow from your clients is managed in Clio. You connect Clio to QBO or to Xero, and then every time that you have one of these transactions happen, you either receive a payment from a client, you receive a retainer from a client, you pay an invoice, those transactions can then go automatically into QuickBooks or Xero. And QBO is QuickBooks Online, by the way, so if you're confused about that terminology, it can automatically go in, and then those transactions are there for you to reconcile when the bank statement comes up or when the transaction comes up in the bank feed. The beauty of that is that these two things function so well together, and you don't have to do that manual double entry. So it's basically entering it, and if you're using a trust account, you have triple entry, right? Because you need to have the stuff that's happening for the client in your practice management software, then you have it happen in your books, and then you have your trust account, which really should be a separate, sorry about that, I should have put my laptop in do not disturb, really should be a separate account in QBO or Xero. So, and I'm not talking about trust accounting today. Definitely not a focus of the topic today. So we'll do a whole separate training on that. But if you need to maintain a trust account, my recommendation is that happens in a completely different login, like a different company in QBO or Xero. And the reason for that is that it can get very confusing whether you're doing transfers between accounts or whether you're doing entering a transaction and entering another transaction on the other side. And if you do it wrong, you can totally mess up your trust accounting. And it's too easy to confuse that. Even my bookkeepers confuse it. So you who are not a bookkeeper, certainly will get confused, and there'll be cleanup that needs to happen on a regular basis. And it's definitely completely avoidable if you have it as two separate companies, because then you can't have transactions going between the two automatically. So that's my little spiel on interacting your accounting software with your practice management software. So now I also say that you should use a bookkeeper, and this is where a lot of resistance might come up for you. And I'm going to tell you a few things. First of all, unless you're a nerd like me and you love numbers and you love getting into the books and you love actually being involved in those transactions in the books, you really have no business being in there from a data entry perspective. Now, you do need to know how to use your software to generate basic reports. You need to know how to look and see what's going on. You also need to know how to recognize that something doesn't look right in case your bookkeeper is making mistakes. So that's something that I would definitely keep in mind as you're going through this process, is that you really, you don't want to do something that you don't like to do. So one of the things in my productivity trainings that I teach is, and I learned this from Michael Hyatt, who I love, he's a productivity expert, is he has you go through all the activities that you do. And for each one, you rate it on two scales. Do I love it or hate it? And it's not either or, it's a scale of how much do I like it or how much do I dislike it? And the other one is, what is my proficiency level in this subject matter? How good am I at doing this? So you need to love it and have a high proficiency at it in order for it to even make sense for you to consider doing the bookkeeping. So if you don't fit into that category, which most attorneys, most law firm owners don't fit into that category, that's my recommendation would be not to do it yourself. Now, another way to look at it, so the proficiency level is an interesting one, because if you're not proficient at it, that means you're going to make mistakes. Then there's cleanup to be done. And then you made a bigger mess than when you started. So that's a different argument. But what's your time worth? When you say and this is a concept that really, if you can understand this, it works for every business decision that you have. And that is, when you say yes to doing something, you're saying no to doing something else. And I'm not talking about, okay, what do you bill per hour? What I am talking about is, you as a business owner, every moment of every day, have a choice. What do I do with my time? And if instead of going out and getting new business, or going out and building relationships with somebody who's going to be a partner and I don't mean a partner level, I mean a partner in that they are sending you referrals, they are doing events with you, they're helping you build your brand as you help them build theirs. If you're not spending time finding the right employees and making sure your employees are productive, all of those things are so much more powerful activities than managing your books. And if you say yes to taking care of the data entry, the mundane data entry of your bookkeeping, you're saying no to those other activities, which means, if nothing else, you're at least slowing down the growth of your firm. You're slowing down your process. And my question to you is how much do you want to slow yourself down? A bookkeeper, you can get a bookkeeper as low as $200 a month. Is it worth $200 a month to significantly slow down your process? So ask yourself, what are you giving up? What are you saying no to by saying yes to doing your own books? And understand that, you can have services for as low as $200 a month. And by the way, if you're in search for a bookkeeper, Dream Builder Financial is my accounting firm. We do bookkeeping. If that's something that's of interest to you, simply send an email to info@dreambuilderfinancial.com, and one of our salespeople will get in touch with you. And I'll put that in the chat as well when I get a moment. So that's using a bookkeeper. Finally, I said create a cadence schedule for paying your bills and updating the books. And batching is something that is a very, very useful productivity tool. And you really should do this with everything that you do. Because what happens is that there's different parts of our brain that we use to do different functions. So when it comes to paying our bills, there's a certain amount of pain involved with that. We don't like doing it, so we tend to push it off. And if we let it weigh on us that we need to get these bills paid, then it's going to affect us being able to do something else. Then if we are being productive in one area, and suddenly we were like, oh, we have to pay this bill, and now I move and I pay that bill. Now I got to re-enter what I was doing, and that re-entry costs a lot of time and energy, brain power for you. So what you want to do is you want to basically set aside maybe two days a month to pay your bills. And I'm not sure if I have a slide for that, but I'm going to follow the slide here and see if I put a slide for that afterwards. If books are not updated regularly, then you don't have key decision-making information. So that's why it's really important to have your books updated regularly. What happens is most business owners, they ignore their books. Even if you're using accounting software, you kind of ignore your books until you have to. Tax time. Now, what good is that information to you? Not a year later, but a year and 3 or 4 months later, because you're first getting around to it in March or April of the following year. It's useless. You need to be able to go into your books, run reports monthly, and be able to see what happened the previous month. See if you're on track to your goals and your results. So now we're going to move to understanding your financials. So I want to move back. So creating a cadence schedule, I recommend for paying your bills that you do twice a month. That'll cover basically everything that you need to do as far as meeting due dates. Because usually you've got net 30 on most bills, unless they're going on the credit card. Then the credit card has a lag from when the statement gets cut until the credit card statement is due. So basically, if you set yourself up to address this twice a month, and literally you could do all your bills for your firm in a few hours. If it might even be less than that. Update your books. You could do that yourself, or you have the bookkeeper do it. Again, that could be weekly, twice a month, whatever cadence works for you. But I wouldn't go in and do it every day. I wouldn't worry about it every day. Understand there's even a lag from when the bank gets the transaction until it clears in the bank, until the bank synchronizes it with your books. So you already have that lag built in. The value of doing it day to day is minimal. But being able to run reports and see what's going on in your business on a monthly basis and a quarterly basis, that's huge. That's invaluable. So you definitely want to be on that cadence. Understanding your financials. So 3 financial statements for the business. This is a basic global thing. Every company, publicly traded companies, have financial statements, and every business, no matter how small, has financial statements. Whether you print them, whether you look at them, is a different story. But I want to explain to you what those are and how to read them, how to understand them. So those, we're going to go into those in a moment. The other big thing when it comes to understanding your financials is key performance indicators. You may have heard this term thrown around, KPIs, and not really understood what it was, or maybe you do understand what it is. And this is not just a financial terminology. As a matter of fact, we use key performance indicators at a much lower level in looking at stuff. So for example, your key performance indicator for marketing might be what your lifetime value of your customer is. But when we draw it back, we want to know how many leads do I need to bring in order to generate the revenue I want based on this lifetime value of this customer. So the key performance indicators can have a very varied and encompassing scope. So we're going to talk about that as well. So those are the 2 major things for understanding your financials. And then the last thing is bank balance versus books decision-making. We need to be able to make decisions from the books. And we need to understand that what we see in the bank account is not the same as what's going on in the business. And as soon as we can understand that, we can stop the biggest mistake that law firm owners make, that any business owner makes really, and that is you wake up in the morning and you log into your bank account and you see what the balance is. And then based on that balance, that drives your actions for the day. Oh my gosh, my balance is too low. We need to collect money. We need to make some sales. Oh, wow, we've got a lot of money in the bank. Let's go buy that printer we needed. Let's go hire that employee we wanted. Those are the wrong places. That's the wrong data set to be looking at to come at that decision. And it's really important that we start to understand that. So our 3 financial statements for the business: profit and loss, or our income statement. And we're going to go into what these are. So, and then there's the balance sheet, and and then there's our KPIs. So I'm actually gonna share my screen here, and I'm gonna show you a. It is not letting me. Let me see, because I have a different camera on. Not letting me share my screen that way. Let me try to do it here. Give me just a second. And let's see. Ooh. Can you see my spreadsheet right now? I'm actually not going to be. I think you can see the spreadsheet. So what I want to show you here is that the profit and loss is a statement that is a picture in time of your business. So for example, this is sample company profit and loss January to December of 2019. And it has an income section, and it could be broken down as many categories as you want. The actual categories is not really important. It's the total income that's important. So there's an income section for the business, and that is the first part of the profit and loss. So you have your revenue, and this is otherwise known as revenue. So you've got your revenue number, and that's key point number one. Now, cost of goods sold, you're typically not going to have that in a law firm. We can, we can eliminate that here, but cost of goods sold would be your inventory and stuff like that comes off. Some law firms like to use cost of goods sold to track how much they're paying an outside attorney to do work for them, but it's not technically the right way to do it. So then you've got your gross profit, which is really your total income, should be the same number for most law firms. Then you've got your expenses section, and your expenses section can be broken down in as much detail as you want. But at the end, you come out with your total expenses. Now, if you take your revenue and you subtract your expenses, you get your income. In this case, it's hard to see it here, but in this particular profit and loss, this is a negative number. So you have 186,000 at the top line here, and you have 197,000 at the bottom line, and boom, you've got a loss of $11,500 for this business. Now, what's important to note is that this is a snapshot of a previous point in time. So you're never able to run a financial statement on the future. You're only able to run it on the past. So what good is that? Well, it gives you a lot of data into what's going on in the company. How did we do? What is our tax liability going to be? There's a lot of pieces of information that we can get from the profit and loss. The other thing is if you understand metrics that make sense. So in other words, let's say marketing should be no more than 10% of your revenue. Let's just say that that's a thing. So your revenue is 18,700 to 11. Your marketing cost should be no more than $18,721. So we come down here to their advertising, their total advertising amount. Well, they spent $74,000 on marketing. So their marketing is significantly above that benchmark. Well, now we can see where there might be an unhealthy portion of this business, right? There's something wrong here. So that now you could start to see right away. Now let's say that personnel should be no more than 20%, right? So it should be no more than 36,000. So if we go down to salaries and we look here, it's 15,000. Well, maybe they don't have enough people on staff. Maybe instead of outsourcing all that marketing, they should bring somebody in-house and have somebody do some of that work. And I'm just throwing that out here. If this is a sample company, we don't know anything about them. So we're just going to, but I'm just going to show you that this is, you can very rapidly take this piece of information and learn a lot about what's going on in the business and where things might be broken or where things might need to be fixed. Now, a balance sheet is different. So an income statement really is the best place to look to see how is a company doing. In other words, are we making money off of our endeavors? Or does our revenue exceed our expenses, and by how much? Well, a balance sheet tracks a totally different thing. A balance sheet tracks assets and liabilities. Assets are things that you own that have value. So let's say the law firm buys a car. That's an asset. The asset is worth $30,000, but you didn't have an expense of $30,000 because you still have the car, right? So you laid out $30,000 in cash to buy the car, or maybe you took on a loan, which we'll talk about in a moment, and you own an asset of $30,000. Nothing really happened to your profit and loss statement because you didn't have a $30,000 expense. You still have the car. So essentially you traded dollars for a car. Now, as you use the car depreciates. The car loses value. As it loses value and as it has other expenses associated with it, like gas and repairs, those are expenses that are being incurred by the business. So now we need to book the depreciation expense on the profit and loss statement, and we also need to depreciate the value of the asset on the balance sheet. So the balance sheet is a way of looking at what is the financial value of the company by looking at just the assets and liabilities. And then if you do some simple math, you subtract the liabilities from the assets, whatever is remaining is the equity in the business that the owner has. And that's essentially what this balance sheet does. Now, one thing is important to understand is a balance sheet is a single snapshot in time. It is not a period of time. So a profit and loss, we'll run it from January to December, or we'll run it from January to March to get one quarter. A profit and loss, we only need to run it for one day. So we can run it on December 31st, and we know what the balance sheet looks like for that year. We run it at the end of the month, and we know what the balance sheet looks like for that month. So the first thing is the assets in the balance sheet. And if there are depreciable assets, it'll have the asset and then minus the depreciation to arrive at the total value. So you got the total asset section, kind of like the income section of the profit and loss statement where everything is listed, and then it's totaled out. Then you've got liabilities, which is credit cards, car loans, things like that are money that's owed, and that is listed in the liability section. Now, every time that you make a payment to a car loan, for example, you're going to decrease the liability by the amount of the principal payment, and you're going to book an expense for the interest that's included in that payment. Unless it's a 0% interest loan, there's going to be an interest expense on it. And then when you have at the bottom, you've got your owner's equity. Okay, so here in this example, I've set it up with mine. So it's listed with my name, but this would be the section that says how much equity do you have in your company. So the liabilities combined with the equity gives you the total liabilities and equity, which has to match the assets. So we have, in this case, 90,200 in assets. There's 81,000 in liabilities, and therefore there is a total equity of $8,600. So this is a very, very big overview, just an overview on these, and we can go into much more detail if people need it to understand the really how this works and how the entries that you're doing in the books correlates to what we're doing. So I'm going to go back to my slide deck, and hopefully you enjoyed that detour, and I still have everybody with me. I just have to rearrange a few things on my screen back to the other side so I could see what's going on the slide deck. And I will resume in just a moment. Okay, I see the comments that the spreadsheet was very blurry. I apologize for that. What I'll do is in post-production, I will have my staff clean that up. And you could go back and rewatch that small section of this presentation. I apologize for that. So back to where we are. So that's our financial statements. Now, key performance indicators, we've got some examples of that are cost per acquisition of a client, which is a measurement of our marketing, sales intake, and cost and effectiveness. There's billable hours, so paralegal and attorney productivity metric. And these are just really high-level examples of what a KPI might look like. Time to collect. That's a measure of your accounts receivable, and it can highlight issues with the collection process. A lot of law firms, especially if they're doing retainers and hourly billing, end up in a big hole when it comes to AR. Usually because of lack of sticking to your guns and to your agreement and to your processes. But sometimes it happens. The retainer runs out during the month. A lot of work is being done that month on that client, and it creates a massive bill. And now all of a sudden the client doesn't pay it, and you're stuck holding the bag. So it's important to be able to measure that. Now, going to the last point, bank balance versus book decision making. So the bank balance shows the current cash snapshot. it ignores unclear checks. It ignores upcoming expenditures. It does not give you that look that you need to see. And I see this slide is messed up. I apologize for that. The when you look at the books, they show the real financial situation of the business. You can see in the books, you can see the unclear checks. You can have future looking budgets and compare the budget to actuals. So that's going to give you a much better look into the business. So if you can build the muscle of using the book, so first you need to have software, then you need to have the data in it to be up to date and accurate. And then once that's the case, you can now make business decisions from the books. You need to stop looking at the bank account as the sole source of decision making. Now, I am going to do a training at some point on Profit First. Profit First, some of you are familiar with it, is a book by Mike Michalowicz. And the idea behind Profit First is that everybody does bank balance accounting. So instead of having you try to change the way that you behave, let's operate within that realm and just operate your business from the bank account by separating the bank accounts into buckets. It works very well for a lot of people. So we'll cover how that works and how to do it, but it doesn't preclude you from needing to do this. You still need to maintain your books. You still need to understand what's going on. Now, the last thing to understand is what is cash flow. It's not the last thing, I lied. But what is cash flow? Cash flow is the cash coming in or leaving. Now, it isn't an indicator of a good thing or a bad thing. It's just what is. The fact that cash came in doesn't have to mean that you made money, right? Cash could come in from different places. Where can cash come in from? Well, there's three main places that cash can come from. And there's a slide missing. So we're going to go back to where it comes from, but there's also 5 places that cash goes to. I just covered why you need to understand where cash flow. But just to reiterate on that for just a moment, because I had a slide there, which meant I wanted to prompt myself to say something. So you need to understand the cash flow of your business, because you need to understand when you need to fill a gap. You need to understand when you have extra. So that's why it's really important to understand the cash flow, which is very different than the profit and loss. Am I making money? The profit and loss can look beautiful, and you can be really short on cash because you've got this huge accounts receivable building and you're not actually getting money for the hours that are being spent on clients. The cash could be short because you have to pay a bunch of liabilities. You got a bunch of credit card debt. That's not affecting your profit and loss statement, but it is affecting your cash flow. It's affecting how, the cash that's in the bank. So it's really important to understand your cash flow. So I want to set the stage here. 3 places that cash can come from: investors, loans, and revenue. So you can have an investor in your business. Now, in the legal space, that's really difficult because right now it has to be owned. Your law firm has to be owned by a lawyer. So to get an investor in means getting another attorney who wants to invest in your practice. More likely you're borrowing money. So more likely you are taking a loan and paying interest on that loan if you need cash for starting your firm or for running your firm. And then money comes in from revenue. Those are the 3 sources of cash coming in. Now, cash goes out 5 different ways. Dividends get paid out to the owner or owners, okay? So if you have a partnership, the partners might get partner payouts. They're called different things in different structures, but essentially the dividends is paying out either return of capital, so money that was invested in is now being paid back, or paying out profits in the business to the owner. Another form of money leaving is paying down loans. So making liability payments, whether it's loans that are due or paying down debt early. So loan payments is a second reason the cash leaves the business. Third reason is operating expenses. So money goes out for buying things. It could be services. It could be supplies. It could be expenses for travel. There's a lot of examples of operating expenses. Essentially, when you think about where money goes in your firm, operating expenses is really where you think of the money going, the rent, everything like that. The fourth is capital expenditures. Our example before, buying a car, buying a building, buying an expensive copying machine. There's many different things that you might spend money on that's a capital expenditure, meaning you're buying an asset that's going to last a long time, and that is going to be used over time in the business. And then the fifth thing, was that only 4? The fifth slide is missing, and that is taxes. So it's not there, it's missing, taxes. So, oh, it's here. It just got two slides combined. Apologize for that. Taxes is the fifth thing, and that's basically where your company is paying taxes. Now, could be that income taxes are paid personally if it's a pass-through entity, but if you have employees, then the company has to pay the employee side of the FICA, Social Security tax, and we're gonna have a whole section on taxes in just a short while. So I wanna make sure that I leave enough time for that. But those are the different ways that money comes in and leaves the law firm. Now, why do you need to understand this? Well, running out of cash can mean losing employees, right? If you can't make payroll on time, how long is your staff sticking around? You could lose vendors if you can't pay your bills on time, or you can't pay them at all. The vendor's not going to work with you anymore. So you're not going to be able to use them. And you're going to be unable to serve clients because you can't pay for the things that you need to do to serve them, whether it's paying court fees, or whether it's paying your staff to work, or whether it's paying your vendors for the work that they're doing for the subject matter that you're covering. Your ability to serve your clients is going to suffer if you don't have the cash to pay for these things. So running out of cash is basically the demise of your business. And the next bullet point is that it takes time to get cash to cover a shortfall. So it's really important to see that there's going to be an impending problem on the horizon. You know, when COVID-19 hit, nobody was expecting it. It came out of the blue, and all of a sudden, lots of businesses were in this situation where they had no cash coming in. They had to continue to pay their employees or fire their employees, continue paying their rent or stop paying their rent. It caused a tremendous cash crunch up front. A smart business owner would have been prepared for that. A smart business owner would have said, okay, I need to have some sort of emergency arsenal to be able to survive if, for whatever reason, something happens and the revenue stops coming in. And that happens when you really have an understanding of cash flow and you understand what the needs are of your business. Think of your business as a person. You have to feed the person, right? If you let somebody go for 3 days without food, they may not survive. And cash is the food for your business. It's the sustenance of your business. If you can't feed cash into your business, the business will not survive. So you have to be able to understand how that works, how the cash comes in, how the cash goes out, and that is the engine of the business. That's what allows the business to run. So you need to be able to anticipate a cash shortfall, take steps in advance to arrange for a cash infusion of some kind. Now, let's talk about debt for a moment, because debt is one of the ways of solving a cash problem. Is debt good or bad? So the answer is, it depends. Debt being good or bad depends on what it's being used for. So if you're borrowing money to grow the business, it's almost always a good thing, unless you're an avid Dave Ramsey fan who swears off debt completely, and there's nothing wrong with that. I'm not passing judgment here. I actually ascribed to Dave Ramsey wholeheartedly for a long period of time, but I see business in a different lens than he does. And I believe that there is very valid reasons and great ways to fuel your business with debt. However, I don't think that you should borrow money to gamble. I think you should borrow money to invest in things that are already proven. For example, let's say that you've proven that you can convert people from a Google pay-per-click ad to a customer, and you figured out that the ad costs you $150 and you can turn around and you can get a customer that's $1,500 on the back end of it. But it takes 9 months from when you first get the lead in Google pay-per-click until you collect the money. Maybe you're personal injury, you're working on contingency, or maybe you're maybe it's I don't know, some other matter. Maybe it just takes time for them to make their decision. Maybe you have a long process to get them to the table to discuss becoming a client. Whatever the case may be, if you have that extended period of time, you've proven that you can do it. Now you just want to increase the amount of clients that you have coming in, that you're working through the process. You might have to have not just the money to spend on the Google ads up front, but you might also need the money to spend on your staff to support working those cases until that revenue comes in. So one of the best uses of borrowed money is to allow your law firm to survive that process when you know you have that revenue coming in on the back end. And it allows you to get to that point. So that's a really good example of a good use for cash, for debt. Another is investing in an asset that's going to improve your business. Now, if you're just buying a car for the sake of buying a car for the law practice, then you're making that decision because that's what you want, not because it's a good decision for the business. But if a car is going to allow you to get to court and to get to meeting with clients and to get to meeting with referral sources, and that's integral in the place that you live, otherwise you wouldn't be able to operate efficiently, then that's an asset that the business needs. And if it's an asset the business needs, in order for the business to grow, then borrowing money for that asset to be able to produce the results for your business is a good decision. So I'm going to start to speed things up because I'm running out of time. If that growth is not certain, then it may not be a good thing. Borrowing money to extend the time frame of a bad problem is a very bad thing. And this is something that is very hard to catch when it's happening. But essentially, if revenue stops coming in, it's COVID-19, revenue stops coming in, if you continue to pay your employees and the revenue is not going to resume, then you're just delaying the inevitable. So now you borrowed money to delay the inevitable. And now instead of just being in pain because you had to fire your staff or lay your staff off, you're now in even more pain because now you've got $150,000 debt on top of it, which you could have avoided. So it's really important to look at why you're borrowing it. And if it's just a Band-Aid, you always should ask yourself the question, if I didn't have access to this borrowed money, what would be the decision I'm making right now? What would be the decision I would make? And that will allow you to really come at this from the correct angle. All right, I think that we're done with debt. Let's see. Okay, so we're moving on to taxes. Now, I'm going to run through this. This could be a whole separate topic. You might know some of it. You might know all of it. But in my experience, business owners do a terrible job of preparing for the ultimate bill that they're going to get from the tax man. So I want to talk about it. There's different types of taxes. So there's payroll tax. There is payroll mandatory insurance. So depending on the state jurisdiction that you're in, there could be all kinds of insurances you're required to carry. There's income tax on the money that you earn. There's also state income tax, which we're going to include in the income tax category. And there's other taxes, which I chose not to list in the slide today. So payroll taxes, the most common one is the FICA tax, 15.3%. And depending on your structure for your business, you might be on payroll and be treating yourself as an employee, or you might be self-employed and be paying this on your tax return on your Schedule C. If you're on payroll, you're lucky because a lot of the mess that people get into is being avoided. But you can only be on payroll if you're an S Corp. If you're a partnership or a LLC that's just being filed as a Schedule C on your tax return, you cannot pay yourself payroll, and therefore you have to pay tax a different way. And that's where people get into trouble. So half of it is paid by the employer, 7.65%. The other half is paid by the employee out of their pay. Now, as the owner, you're paying both sides of it. Now, the mandatory insurance that we have is the unemployment insurance is one of them. We're going to give a few of them here. Workers' compensation insurance, family leave insurance, and there are others depending on the state, but they can add up quickly. Those costs can add another 3 to 5% of deductions from. It's actually not from the employee's payroll. Often it's the company that's paying for it. Often you're paying that on behalf of your employee. Now, income tax, it depends on how you're structured. If you're a C Corp, then you're being taxed at the corporate level, flat tax of 21%. Most law firm owners, most law firms are not a C Corp. Many states don't even allow a C Corp for a law firm, but it is possible for some people, for some of you to be in that position. U.S. individual income tax is taxed on a progressive schedule from 0 to 37%. Progressive means that at every increment, you're paying that level. So from 0 to $9,700, your tax is 10%. So the first $9,700 of your earnings is taxed at 10%. When you earn above $9,700 and go to the next level, that's taxed at 12%. And then the next level is at 22%. So that's how it works. It's not like when you get to the 22% tax bracket, now your entire income is taxed at 22%. That is not how it works. So it's a progressive schedule tax. Now, state income tax is another example. Most states and some cities have their own income tax. New York State income tax ranges from 4% to 8.82%, and New York City ranges from 3.078% to 3.876%. Now the slide's cut off. I don't see the number in front of me, but New York City also has a business general corporation tax, and I believe it's 8.6%, something in that range. It's a lot. So think of somebody who's located in New York City where they're paying and they're earning good money. They could be paying 37% on their income tax. At the company level, they're paying another 8% to New York City. Then they're paying the New York City income tax on top of that. Debatable because some of that general corporation tax gets credited back to them on their personal side. But then they're also paying their FICA. They're also paying their 15.3%. More than 50% of their income is going to be going to taxes, which is wild to think about. Now, sales tax is something that we're just going to brush on. It's not a business expense. It's a pass-through. You are the agent for the state. Basically, you collect it, you pass it through. But most states do not assess sales tax on legal services. Now, you do need to pay attention because very recently, within the last 6 months, the state of Maryland was talking about taxing services, which would have included legal services. So I don't think it's going to happen, but if it does, it's going to be awful. So you definitely need to monitor that and make sure that you're not required. And you can't spend the sales tax you collect. You're just holding onto it for them. Now, this slide is cut off, and I'm sorry, I didn't go through these slides before using them. My assistant made them for me yesterday, so it didn't quite work out the way that I wanted with how they're laid out. But let me see if I can move it up a little bit. That might help with drop. This is just one example that I'm using. So a solo lawyer generates $100,000 in net income in profit, right? After expenses, you earned $100,000. Your FICA tax is 15.3%. That's $15,300. Your income tax is in the 22% tax bracket. That's $10,254. Your state income tax, for this example, I chose 5%, depending on the state. I mean, if you're in Florida or Texas, it's 0, but it's $5,000. Your total tax liability on that $100,000 in income is $30,554. That means that your total take-home pay is $69,446. So out of the $100,000 you earned, you're only taking home less than $70,000. The rest is going to taxes. Now you can see how you can easily get into trouble, because if you haven't been paying taxes all year, suddenly you have a bill to pay at the end of the year of 30 grand, right? We have a pay as you earn system. That means that as you earn money, you have to pay taxes on it. And when you're self-employed, when you're W-2, when you're working for somebody, that tax is withheld on every paycheck. You don't have to worry about that. At the end of the year, you do your tax return and you either owe money or you get some money back, but most of your taxes have already been collected on your paycheck. When you're a business owner, that's not the case. So the system that's set up for you is that you have to make 4 quarterly estimated payments throughout the year. And if you're not disciplined with that, then you can have a massive tax bill at the end of the year, which builds a steep hole very quickly. And that most business owners, when they come to have us do their taxes here, more than 50% of them come to us with a massive balance owed to the IRS or a major cleanup that they need because of this mistake. So what can you do to mitigate the risk of not withholding enough tax and not putting it away and not sending it to the IRS and to the state? You can create a separate tax account at your bank, and you keep a separate bank account. And basically what you do is you just determine a certain percentage of your top line revenue. Don't try to calculate your net income every month. That is going to be that is going to make you nuts. Take a top line revenue number and say, okay, if we collected X amount of dollars in this quarter, then we're going to pay X amount in taxes. And you just make that estimated payment. But you also, every month when you're doing your bookkeeping, you're allocating that money into the tax account. Now, a good number to use is 15%. It's going to vary on your situation. It's going to vary where you live. It's going to vary, but it's a very close number for most people. As a matter of fact, if you go back to our example earlier, I'm actually not going to try to go all the way back. I'm really tight on time. If you brought in 100,000 in profit, you probably had a top line revenue of 200,000. Your tax was 30,000 in the example, almost exactly 15% of 200,000. That's how it works out for most businesses. Now, if you're not making money, if you're losing money, then you're not going to have a tax bill. So this is assuming that you're running your business healthy, that you have a healthy profit margin. But if you don't generate income from the business, then you're going to avoid your FICA tax, your income tax. You're going to get away with very little taxation. So never touch the tax account except to pay taxes. And then at the end of the year, when you file your taxes, if there's money left in it, then it's a surplus. You get a bonus. You can apply it to something else, put it for a rainy day fund, boost your tax for the next year, whatever you want to do. But during the year, just put that 15% into that account, make your quarterly estimated payments, and just don't touch that money for anything else. That's where people get into trouble, by dipping their money into that. Now, financial processes and why they are so important. Managing finances can be super easy, but you can also destroy your business if mistakes are made. And that's why it is so important to start to develop processes for everything in your financial, in the financial realm in your practice. You should create processes around billing. That ensures that all work that is done is billed out in a timely and efficient manner. One of the, in the Clio Trends report, Melanie would be better talking to this than me. I don't know it off the top of my head, but I know that in the Clio Trends report, there's some crazy numbers about the amount of your hours that are actually billed and the amount that are actually collected, and they're different. So I think it's like something like only 2.6 hours, something like that, in a day are actually billed from a solo attorney, and only 1.8 of those hours end up being collected, which is crazy numbers when you think about it. So creating processes around collections also ensures the collection of fees earned and also brings problem clients to your attention quicker. It also eliminates the bad debt that's going to happen. So if you stay on top of your client retainer replenishments, if you stop work on a client when they run out of money and don't continue working and hope they're going to pay it, you create processes around that so that your attorneys know when they've run out, so that there's an advance notice to the client that they're getting close, that they need to replenish it. If you have processes built into that, then you can make that a good experience for your client, and you can also eliminate all the risk that you take by continuing to operate in that bad habit. Creating processes around paying bills ensures the vendors are paid timely and you're not unnecessarily distracted. We talked about that earlier. Creating processes around the planning will allow you to address problems before they occur. So we plan for the future, we plan for what's going to happen, and with that plan, we're able to see whether we're going to have a cash shortfall, whether we're going to need to address an issue, and we can address that issue in advance.
That's it for this week's episode of Profit with Law. If you have enjoyed the show, please consider sharing it with at least one person. Imagine how many lives we can change if we each shared this episode. Another way to share the episode is on social media. We appreciate your support and look forward to you joining us again next week.